Bitcoin fell below $100,000 recently, and the Fear and Greed Index has collapsed. Yet beneath the panic, the fundamentals tell a very different story. Major crypto legislation is passing, and the Fed is easing. This striking divergence between retail fear and institutional opportunity raises a crucial question. Is this the ultimate buy signal, or the start of something much worse? That's why today we'll unpack what sentiment really measures, explore the tools flashing red, and reveal the one thing you must master to turn fear into profit. My name is Guy, and you're watching The Coin Bureau. First up though, I'm not a financial advisor, and nothing in this video should be taken as financial advice. It's educational content designed to help you understand how sentiment shapes the crypto market. If that sounds good, give that like button a tap, and let's get into it. So, what does this extreme emotional climate actually mean? For most people, crypto seems like a complex web of tokenomics, smart contracts, and macro policy. But in the short term, price comes down to two simple forces: human psychology and belief. As the Japanese rice merchant Honma Munehisa discovered back in the 1700s, markets are ruled by two emotions: fear and greed. And these emotions follow patterns. That's why technical analysis works. It's essentially a record of human emotion over time. But there's also a philosophical side. Prices aren't just numbers, they're reflections of what people believe something is worth. Value isn't objective, it's subjective. Every trader uses their own indicators and beliefs to act on that perception. And that's where Warren Buffett's timeless line rings true. Be greedy when others are fearful, and fearful when others are greedy. It sounds easy, right? But executing that principle is what separates the winners from the more than 80% of retail investors who lose money. That's because most people can't detach from their emotions. The pain of losing money is roughly twice as powerful as the pleasure of making it, a cognitive trap known as loss aversion. The market knows it and uses these emotional blind spots against us. Which brings us to today, specifically November 2025. Right now, the Fear and Greed Index is sitting at fear, just 24. A month ago, it was deep in greed at 74. That is a massive collapse in confidence. But here's the paradox. Fundamentals look fantastic. The Fed is cutting interest rates, major crypto legislation has passed, and altcoin ETFs are waiting for approval. So, why the panic? Well, first came the institutions. After months of inflows, spot Bitcoin ETFs suddenly turned, seeing billions in outflows through November, a clear round of profit-taking from the very players who kicked off the rally. Then came the OGs, the long-term holders. The new ETF liquidity finally gave them a way to cash out without crashing the price. On-chain data shows these early believers have been distributing heavily, sending roughly $293 million worth of Bitcoin to exchanges every day. And finally, the leverage traders. When Bitcoin broke below the critical $100,000 level, it triggered a cascade of liquidations. So, put it all together and you get a market purged by forced selling, not broken by fundamentals. Institutions and OGs took profits into good news, while retail panic fueled the final flush. That's why we must look beyond emotion, because what we're seeing isn't necessarily a sign of the end, it's the aftermath of coordinated profit-taking. Now, if we want to follow Warren Buffett's timeless advice, we need reliable thermometers for fear and greed. And that brings us to the most popular and often most misunderstood sentiment tool in crypto, the Crypto Fear and Greed Index. It's built from several market metrics, but it's not particularly useful unless you understand what's under the hood. Modelled after CNN's stock market version, it updates once a day, making it best for broader, longer-term sentiment rather than intraday signals. So, what exactly drives it? Well, it's built from a mix of metrics, including volatility, trading volume, social media sentiment, Bitcoin dominance, and Google search trends. In other words, it gives you a broad snapshot of how confident, or terrified, the market feels at any given time. So, as an example, when volatility spikes during fear, volume usually dries up, social mood turns negative, and capital flees into Bitcoin, pushing BTC dominance higher, as we saw recently when it climbed past 61%. When all these readings align, the index plunges into fear territory, exactly where we are right now. But one of the earliest ways to track sentiment yourself is through Google Trends. It's a powerful, free way to see who's actually paying attention, to separate the crypto natives from the tourists. Searches for altcoins usually come from existing investors who already know the space, while queries like buy crypto come from newcomers just entering the market. So when that altcoin search trend starts climbing, it's often the first hint that retail is waking up again, and that is music to every bag holder's ears. But here's the problem. These surface-level tools are easy to read, but the real question is, can we actually trust them? After all, sentiment data is only as good as the emotions it tries to measure, and those emotions are easily distorted. And that's why so many seasoned traders treat these indicators with caution, and it all comes down to what's known as the tourist problem. Every cycle brings a flood of newcomers who disappear the moment prices fall. Only a small fraction ever post publicly, which means the data we're analysing represents a tiny and often misleading slice of the market. Think of it like this. If these sentiment tools genuinely worked, their creators would be absurdly wealthy. The fact that they're not probably tells you all you need to know. And speaking of which, if you want to save on trading fees when your trades go your way, then make sure to check out the Coin Bureau deals page. There you'll find exclusive sign-up bonuses worth up to $100,000, trading fee discounts of up to 50%, and cashback offers as high as 75% on some top exchanges. Just hit the link in the description or scan the QR code on screen to browse all partner offers and claim your deal. These offers won't last forever though, so grab them while you can. Now, if the market constantly plays on our emotions, can we really trust indicators that track those same emotions being manipulated? Well, the short answer is no, not on their own. And to see why, we need to move beyond retail sentiment and look at macro sentiment, the kind measured through big on-chain data. Now, two of the best tools here are the MV-RV Z-score and the Pi Cycle Top indicator. Let's start with the MV-RV Z-score. It's essentially a gauge of collective sentiment. It compares Bitcoin's market value, the price new buyers are paying, to its realized value, which reflects the average cost basis of long-term holders. When the Z-score drops low, market value falls below realized value, a signal of mass capitulation and extreme fear. When it climbs high, market value shoots far above realized value, a sign of euphoria and greed. Now, historically, this tool has done a remarkable job identifying cycle tops and bottoms. But this cycle has been different. Even as Bitcoin hit new all-time highs, the Z-score stayed unusually muted, bouncing in the mid-range instead of exploding into the red zones we saw in 2017 or 2021. Why? Well, because the structure of the market itself has changed. Institutional flows now dominate. Spot Bitcoin ETFs and digital asset treasury firms, or DATs, have become consistent buyers. They're not speculating like retail traders. They're averaging in, buying every dip, and often buying as price rises. This steady structural demand soaks up supply and re-anchors Bitcoin's cost basis higher. As a result, the old parabolic emotion-driven melt-ups have become far less dramatic. In practice, that means the Z-score is now more reliable for bottoms than for tops. A proper bottom usually requires a brutal capitulation, not just leverage retail being liquidated, but smaller treasury firms under debt pressure. That kind of forced selling is exactly what drives the Z-score to its extreme lows. Okay, next we have the Pi Cycle Top indicator. Now, this isn't a direct sentiment reading, but it tracks the effects of sentiment. It's essentially an alarm bell for when markets run too far, too fast. It triggers when the 111-day moving average crosses decisively above double the 350-day moving average, and its historical accuracy is astonishing, flashing within days of previous cycle tops. So, both the Z-score and the pi cycle top indicator illustrate the same paradox. Cycle tops are not just technical events, they're psychological ones. They happen when traders are utterly convinced prices can only rise. That's when FOMO peaks, and that's when the smart money quietly exits. And you can learn more about those indicators in a video right over here, by the way. That being said, though, not every asset plays by those rules. If you rely solely on macro sentiment indicators, you'll miss opportunities hiding in plain sight. Just look at Casper, which delivered a 700x return back during the 2022 to 2023 bear market. It completely defied the broader cycle, a reminder that strong fundamentals, an engaged community, and specific catalysts can override macro sentiment entirely. So here's the ultimate lesson. Context is king. You must pair clean technicals with at least one verifiable fundamental tailwind. And when the broader backdrop argues with your chart, listen to it, because sentiment without context is just noise. But with the market sentiment often manipulated by illusion, what mechanical forces are actually pulling the strings, and how can we spot their traps? The entire process of market manipulation, from the smallest altcoin pump and dump to the biggest Bitcoin crash, is driven by one thing: liquidity hunting. This is the foundation of smart money concepts, or SMC. SMC argues that markets aren't fair. They're dominated by banks, funds, exchanges, and elite traders, whose primary goal is to exploit the so-called dumb money, which, let's be honest, is the rest of us. They know how retail operates. They know we make emotional decisions, and they know where we cluster our orders and stop losses. So, their strategy is simple. They use algorithms to push price into key liquidity zones, triggering liquidations and scooping up the orders left behind. It's not a conspiracy, it's just how professional markets operate. In practice, this creates a paradox. Bullish sentiment often leads to bearish price action and vice versa. If smart money sees sentiment collapsing while price trades sideways, they know the crowd expects a dump. So, in a classic contrarian move, they pump the price to trigger short liquidations and ignite FOMO from retail traders. But how does this happen with multi-billion-dollar assets like Bitcoin or Ethereum? Well, it all comes down to one thing: liquidity concentration. Liquidity tends to cluster at key support and resistance levels, the top and bottom of the order book. Once a buy or sell wall breaks, there's little friction left to slow the move. If a whale executes a huge order, price can extend quickly because few want to step in as liquidity providers of last resort. In other words, manipulation doesn't require massive force, just the right nudge at the right time. And this is why we need to distinguish between price action driven by emotion and price action driven by automation. When you see a sudden spike or flash crash, like the chaos around Trump's tariffs that rocked markets and caused billions in liquidations earlier this year, that's not emotion, that is mechanics. And yet, many traders still draw emotional conclusions from moves caused purely by forced selling. If the move was mechanical, your technical analysis is probably misleading. But there's another mechanical trap in the market, and that's the notorious CME gap. The derivatives market is estimated to be 4 to 5 times larger than spot, giving it huge influence. The CME, while smaller in crypto terms, is the main institutional gateway. And here's how the trap works. Large institutions often run a basis trade, buying spot Bitcoin, often via ETFs, while shorting the same amount on the CME futures market. This lets them capture a small yield from price discrepancies without taking directional risk. But the CME closes over weekends. So if spot prices move sharply while it's shut, that hedge breaks down. When trading resumes, though, these institutions must rebalance, buying or selling Bitcoin on spot markets to bring prices back in line. The result is that the gaps between CME's Friday close and Monday open get filled roughly 70 to 90% of the time. That creates a feedback loop of volatility, often detached from retail sentiment. For traders, these gaps can be opportunities, but also traps. If you chase them with high leverage, expecting instant fills, you could get wrecked before the move completes. This is why your edge lies in technical awareness, not emotion. In volatile but sideways markets, the dreaded chop, tools like the Relative Strength Index, or RSI, and Bollinger Bands are far more effective than following social sentiment. The key is simple: avoid diddling in the middle and focus on trades near the extremes where the odds are in your favour. Which brings us to the most crucial part of it all, the 6 inches between your ears. Or, in simpler terms, your emotions. The most sobering statistic is that more than 80% of retail crypto investors lose money. And the number one cause isn't a lack of technical knowledge, it's emotional decision-making, especially the reluctance to take profit. This failure is rooted in the same cognitive traps we discussed earlier. When your crypto is rallying, it's easy to fall for the illusion of control, believing you can time the exact top. And when prices fall from an all-time high, loss aversion and anchoring bias kick in, making a 300% gain feel like a loss because you're anchored to that previous unrealized peak. These are the psychological scars that prevent disciplined profit-taking. So, the key to surviving this market is removing emotion from your decisions. You must think like a professional trader, and that requires 2 things: mindfulness and discipline. First, embrace mindfulness. Learn to observe your thoughts without reacting impulsively. Before you execute a trade out of fear or greed, pause and ask yourself 3 critical questions. Am I taking profit because it aligns with my plan or because I'm scared? Would I still hold this crypto if I didn't already own it? And, perhaps most importantly, what would I advise someone else in this same situation? Taking a deep breath, quite literally, can reset your nervous system and stop you from reacting to volatility. Second, trade based on necessity, not expectation. Anchor your selling decisions to real-world financial goals, not arbitrary round numbers like $10,000. For example, if you need $15,000 to pay off debt and your portfolio hits $50,000, sell exactly what you need to meet that goal. That links your choice to rational purpose, not emotional euphoria. And this is where structure matters. You need a systematic, tiered exit strategy that eliminates the risk of selling everything too early or too late. If you're a Bitcoin holder, history suggests that at this stage of the cycle, it's safer to be early than late. If you're not holding long-term, taking some profits now might be the most prudent move, especially given the continued volatility from the macro liquidity squeeze. For altcoins, though, a scaling strategy makes more sense. Most are sitting near the bottom of a multi-year range, and history shows that a bounce is more likely than a total collapse before the bull run ends. You can scale out gradually. For example, take 25% at the monthly Bollinger Band moving average, then another portion at the next major resistance or psychological level. For high flyers like Ethereum and Solana, you need to front-run the crowd. Everyone expects ETH to hit 10,000 and Sol to reach 1,000. Your edge lies in setting take-profit targets just below these psychological thresholds, say 7,000 to 8,000 for Ethereum, so you exit before the whales dump on retail chasing round numbers. Now, of course, all of this assumes we even reach those valuations. But the dream of a bullish end to 2025 isn't dead, it's just hanging by a thread, waiting for institutional capital to fully flow in. Only time will tell how this plays out. But remember, your greatest edge in this market isn't finding the perfect indicator, it's mastering your own mind. And if you want to see how tools like ChatGPT are slowly taking away this very capability, then check out our video on that right over here. And if you haven't subscribed yet, make sure you do that right here. Okay, thanks for watching, and I'll see you again very soon. This is Guy, signing off.